So for today's video, we're going to be talking about real estate investment financing. Now, one of the most popular business models out today are short-term rentals, right? So we're going to be taking a look behind the scenes, looking at some of the numbers behind some deals, and I'm going to be playing out some different scenarios so you get a better understanding of what it actually entails to buy an investment property, either for, let's say, short-term vacation rental, Airbnb, or even a long-term rental. And so before we dive into some of the numbers, I just wanted to give you guys some bit of an education for those who might be new to this. And before we dive in, by no means am I a real estate expert, but I do work with a lot of different real estate lenders on the private side. So we're really talking about non-owner occupied investment real estate. So this right here is just for illustration purposes. This basically shows some of the requirements for 30-year loans for residential and vacation rental properties. Now, right up here, this matrix, you have LTV to credit score. And this pretty much is the baseline for determining the interest rate, right? And so you have a matrix that shows credit score. And across here, you have loan to value, which is basically the percentage of the loan to the value of the home. And there's different criteria that's going to determine what your LTV is. And so when you look at this matrix, let's say you have a high credit score, 740 or higher, then you're going to qualify for up to 80% LTV. Now take notice, right? So the higher the credit score, the lower the rate. And then also when we're looking at LTVs, the lower the LTV, that pretty much means, you know, you're putting up a higher down payment. So for example, if you're doing, let's say 60% LTV, that means you're going to be putting down 40%. Therefore, the rate is going to be slightly lower. So as you can see, as LTV increases, so does the rate. And then when we're looking at credit score, as credit score decreases, the rate increases. So the higher the LTV, the higher the rate, right? Because you're putting down lower down payment, which means is going to be a higher risk for the lender when you're putting down a lower amount. And the credit score and the interest rate are going to be inversely related, right? So the higher the credit score, the lower the interest rate. So this matrix basically just shows you what the base interest rate is. And so there are adjustments that we're going to go over as well. And again, this is just for illustration purposes. These aren't, you know, actual rates that you'll be paying in today's environment. In fact, they're much higher. So right here, this just tells you the loan terms, right? 30-year maximum loan to value, 80%. Now, here's one thing I just wanted to clarify because a lot of people don't understand this. When we're talking about non-owner occupied investment real estate, it's going to be different than owner occupied where you'd actually be living in. So for owner occupied real estate, you know, there's a lot of different programs like FHA where you're putting down, you know, as low as 3.5%. But on the non-owner occupied investment side, you really aren't going to be getting much higher than 80% LTV. Now, there might be some programs out there where you can get 90% LTV, and that's in rare situations. But typically, if you're a very experienced investor, some other borrow requirements, right? So investor only, individuals, LLCs, corporations, limited partners. So you could basically title the property under a business. Minimum assets, so 6 months PITIA. Now I'm going to go over exactly what that means. So pretty much what this means is that the lender wants to see that you have at least 6 months of principal, interest, taxes, insurance, and associations net of down payment and closing costs. So aside from having the down payment and closing costs, you're also going to have to demonstrate that you have 6 months of reserves to cover the debt service for at least 6 months. Now, the reason why that is because they don't want you to just completely go broke after you put down your down payment and your closing costs. And then they're also looking at your middle score of 3, and then they're going to take the one that's in the middle. So if you have 680, 690, and a 700, they're going to base all of the credit score, loan to value, all that's going to be based on your middle score. So just keep that in mind. This just goes over the different property types. I'm not going to go too deeply into this because there's different programs, but basically you have a minimum debt service coverage ratio. So what is debt service coverage ratio? So up here is an example. Let's say you have Airbnb property or a long-term renter, right? So debt service coverage ratio is going to be the monthly rent divided by, in the acronym I just showed you, PITIA. So that's principal, interest, monthly taxes, monthly insurance, and monthly association fees if applicable. Pretty much what this means is how much is it costing you to service the loan and how much income is actually being generated from the rental property on a monthly basis. So let's say it's costing you $1,200 per month, but you're bringing in $1,800 per month. So you have about a $600 spread between what it's costing you versus what you're generating in income on that property. And right here, this gives a debt service coverage ratio of 1.5. So most lenders, I would say, is usually like 1.1 or 1.2 from all of the lenders that I work with. And recently it's actually gone up a little bit just given the current environment we're in right now. And so this just gives an illustration. So like in this example, right down here, it says minimum debt service of 1.2. So in this situation, this particular deal would work because it meets the minimum 1.2 or is greater than, 1.2. It's actually 1.5. So that means there's enough spread between what it's costing you to service the debt and how much income is being generated from the property. Now, right here, you have different rate adjustments. So as I mentioned, right over here, this is just kind of like the baseline rates, right? But then you also have rate adjustments depending on the structure of the loan. So you have adjustable rate mortgages, 30-year fixed. As you can see right here, origination fee, and then you have these rate adjustments, right? So pretty much what this means is that if you want to buy down the rate, you're going to pay a higher origination fee, right? So the higher the origination fee, the higher the rate buy down, right? So you're pretty much paying a higher percentage on the origination fee to get a lower interest rate on the loan. So that's pretty much what that means. All right, so right here, we're just going to price a deal, right? So the first step is to select the program. So let's say this is a long-term rental, right? And use of funds, purchase. Now there's different programs, you have refinance, cash out refinance, delayed purchase. So let's just say a purchase just to keep it simple. And this is going to be for a single family house. And so right here, we're going to enter in some loan information. So U.S. citizen status, credit score, let's just say, 760. I'm actually going to pull listing off of Zillow just for illustration purposes. So right here, we have this property right here. So I'm going to enter some of this information. Now, right here, you're going to enter in the rental information, right? And so let's just say, monthly rental. And right here, they give you the options, right? So lease, LTR, that's long-term rental, STR, that's short-term. Then you have vacant, long-term, vacant, short-term. So let's just say for illustration purposes, this is a leased long-term rental and it's going for $2,500 a month. And so we're going to save that information right there. And then right here, you're going to set the property address. So I'm just going to select this right here, hit save, and then we're going to hit, okay, hold on, prepayment. Okay, let's just say no prepayment, calculate pricing. All right, so right here, as I was showing you on the other diagram, right, you can buy down the rate. So let's just go over this real quick. So you have your lender points, the loan size, the rates, and then you have loan to value, PITIA, principal, interest, taxes, insurance, association. So this is going to be basically your monthly payment, and then debt service coverage ratio. So this is very important. The debt service coverage ratios are much higher, right? 1.76. This right here shows the different scenarios depending on, the rate buy down, right? So let's say, you wanted a lower interest rate. Now, as I was showing you, origination fee or the lender points and the rates are going to be inversely related. So you're going to have a lower rate, but you're going to be paying a higher origination fee at closing. And so just for illustration purposes, I'm just going to select this first scenario. And then right now here, so this pretty much lays out exactly what you're going to need in terms of estimated down payment, closing. And again, this isn't final. This is just a pricing. Once this is actually sent to a lender, they'll actually, look a little bit deeper into these numbers and give you a more precise estimate of what your closing costs and stuff will be. So right here, amount requested, again, the purchase price $260, the loan amount is actually going to be $195 because you're only going to be getting 75% loan to value. Now, right here, you have the option of, choosing, let's say if you want to do a lower loan to value, that means you'd have to bring more to the table. And as you can see, just based on the information, you can't go any higher than the 75% loan to value. Now, right here, total PITIA. So that's going to be the monthly payment. And then you have total origination points. And then right down here, it has down payment. So you're going to have a down payment, $65,000, origination fees of $7,800. There's a closing fee of $995, underwriting fee of $495. So total estimated closing costs, $74,290. And then they also have estimated liquidity requirements. So on top of the, estimated closing costs, you're also going to have 1% of the loan amount as a liquidity buffer, and also debt service of $12,757.94. A lot of lenders want to see that you have a certain amount of cash reserves in excess of your estimated closing costs and down payment. So pretty much they want to know if they give you this loan, you're not just going to go broke right after. So that's why there are certain liquidity requirements. Now, let's say everything is good and you want to move forward this. What I would do is just hit this download button, download pricing, and then it'll produce the pricing. So right here is just the pricing term sheet. It has the address, the loan information. Pretty much what I would do is I would just send this to you. And then if everything looks good from your end, then what I would do is just forward this to the underwriter. And then from there, you and the underwriter can work on, moving forward through the process. Now, again, if anyone is interested in getting a pricing quote, I've dropped a link in the description of the video. You can submit your deal. Now, again, make sure that you include all the required information, because otherwise, if there's anything incomplete in terms of, your name, the property address, anything like that, then I won't be able to move forward with providing you with a pricing. Now, and again, on the non-owner occupied private investment real estate, you're going to usually be putting down, I would say 20%, and that's pretty standard. And I know now it might be a little bit higher. As the example I showed you, it was only 75% LTV. And again, that's going to depend on the lender, but that's usually what it is. And if you're an inexperienced investor, meaning you don't have any deals under your belt, you can expect to have a much lower loan to value, meaning you're going to have to put down a much higher down payment. Anyways, that's all for today's video. Let me know your comments and questions right down below. And until next time, take it easy and we'll talk to you soon. Peace.